In the next few minutes, what changed, what it costs, and what buyers are not being told.
All right, so there's something I want to address before we get into the numbers today. Travelers is expanding homeowners insurance availability in California, and I want to be clear, that is genuinely good news. A major carrier moving back into underserved areas is real progress. But here's the thing about good news. Sometimes it gets used to close a conversation that isn't actually over. Because when you look at what's actually happening in this market, not the press releases, the actual data, it doesn't look like healing. It looks like a rebuild. New rules, new pricing models. And when California rewrites its insurance rules, what typically happens next is that more cost gets shifted onto many of the people who buy, sell, or own a home in this state. The specific number I want to walk you through today doesn't appear in any listing. It's not on your mortgage pre-approval. Your agent probably hasn't mentioned it. And for hundreds of thousands of California homeowners, it's quietly reshaping their monthly cost of ownership. That's the hidden cost. And that's what today is about. Before I get into any data, let me give you a quick picture of who this is actually hitting. The first person is a buyer, spent a year saving, got pre-approved, found the home they wanted, 3 weeks out from closing. The lender had a placeholder number for homeowners insurance. When the buyer went to actually bind coverage, the real quote came back way higher. The deal fell apart. The second person has owned their home for years, never filed a claim. One morning, they get a letter. Their carrier isn't renewing their policy. Not because of anything they did wrong, just because of where their house sits on a map. Neither of those situations is unusual. Both are becoming more common, especially in the higher exposure parts of the state, where the data bears that out. And both trace back to the same underlying change in this market, one that was building well before the January 2025 wildfires, and that one carrier expanding isn't going to undo overnight. Let's get into it. You've probably heard of the FAIR Plan by now, California's insurer of last resort, the program that exists for homeowners who genuinely can't get coverage anywhere else. That phrase, last resort, matters. This is not a full homeowners policy. It is a safety net. And safety nets are not designed to hold up the entire system. Between September 2021 and September 2025, FAIR Plan enrollment grew 165%, from 242,000 policies to 642,000. That's from MoneyGeek's April 2026 analysis of official FAIR Plan enrollment records. By the end of 2025, the FAIR Plan's own published data, reported by the San Francisco Chronicle, put the number at 646,892. Now here's the number I need you to hold on to. Statewide, the FAIR Plan covers about 1 in 20 insured California homes, 5%. You might hear that and think, okay, that's pretty contained. Here's the part people miss. In California's 10 highest wildfire risk counties, the FAIR Plan was already writing roughly 1 in 3 residential policies by 2023. That comes directly from a California Department of Insurance fact sheet, 1 in 20 statewide, roughly 1 in 3 in the highest risk counties. The insurer of last resort has become the insurer of first resort, not by design, by default. And while the FAIR Plan was growing, the private market was moving in the opposite direction. Private insurers wrote 28% fewer new California homeowner policies in 2023 than they did in 2020. The California Department of Insurance recorded 788,000 policy non-renewals in 2023 alone. In 46 of California's 58 counties, more policies were canceled or non-renewed than new ones were written. So who filled that gap? The FAIR Plan did. The backup became the plan. And here's the part most buyers and sellers completely miss: what the backup actually covers. The FAIR Plan is not a homeowner's insurance policy. Let me put it plainly. The FAIR Plan is not homeowner's insurance. It covers fire, lightning, smoke, internal explosions. That is the list. That is all of it. No theft, no water damage, no personal liability. If a pipe bursts and floods your kitchen, not covered. If someone slips on your front steps and sues you, not covered. To get anything resembling a standard homeowner's policy, you have to add a second policy on top of the FAIR Plan. It's called a difference in conditions policy, DIC for short. 2 separate policies, one on top of the other, to do what one used to do. What does that actually run? The average FAIR Plan policy costs just over $3,000 a year as of September 2025 per the FAIR Plan's own data. A standard California homeowners policy averages between $1,430 and $1,540 a year, according to Bankrate and MoneyGeek, so the FAIR Plan by itself is already roughly double. Then add the DIC. According to insurance industry analysis from the agency Old Harbor, the combined FAIR Plan plus DIC frequently runs $5,000 to $6,800 per year for a standard single-family home. That's $275 to $440 more every month than a comparable standard all-perils policy. I want to be precise. That's industry analysis from a licensed insurance agency, not an official state figure. But the DIC requirement is independently verified across multiple sources. This is where the math changes. The FAIR Plan has a 35.8% average rate increase request sitting in front of regulators right now, largest they've filed in years. As of early May 2026, not yet approved or denied. If it passes, the whole thing gets significantly more expensive. And on top of that, insurance analytics firm Insurify projected in early 2026 that California homeowners overall could see rates rise approximately another 16% by year's end. That's stacking on the 16% cumulative increase already recorded since 2023. That's Insurify's own projection, not a state forecast. The California Department of Insurance hasn't put out a comparable number, but it tracks with what's currently in front of regulators. 2 policies, a 35.8% rate hike pending, another 16% projected on top of that. This is not a crisis ending. This is a crisis being repriced into the permanent cost of owning a home in California. And this is the part buyers need to slow down for. The California Association of Realtors calculated that the full monthly ownership cost on the median-priced California home, mortgage, property taxes, and insurance, runs approximately $5,330 per month at current rates with 20% down. To qualify for that home, CAR says you need a household income of at least $213,200 a year. California's median household income is around $80,000, $213,000 to qualify, $80,000 actual median. That is not a gap, that is a wall. CAR's own Housing Affordability Index puts 82% of California households on the wrong side of it. The insurance situation isn't building that wall. It's making it harder to get over. So here's what I tell any buyer right now. Do not use a lender's placeholder insurance number. That line is almost always too low, based on what the previous owner paid, often years ago, often with a carrier that no longer writes in that area. Before you write any offer, get a real quote on the actual property from an actual broker. Find out whether that address qualifies for a private policy, or whether you're looking at FAIR Plan plus DIC. The difference can be hundreds of dollars a month over a 30-year loan. That number needs to exist before you go under contract, not after. If you're selling, you're carrying risk you may not have priced in. Every buyer walking through your home is going to run an insurance check before they finalize. In the 10 highest exposure counties, non-renewal rates hit roughly 16% in 2023. Nearly double the statewide average, and triple what they were a decade ago. And this is where some deals can fall apart. Not because of the appraisal, not because of the inspection, but because the insurance number no longer works. Your buyer gets approved, you accept the offer, they go to bind coverage. No private carrier will write the property. The FAIR Plan plus DIC stack pushes their monthly payment past the line. The deal collapses. You're back on market. If you're listing in any area with wildfire exposure, know your insurance profile before you list. Know what a buyer is going to face when they try to bind coverage. If the answer is FAIR Plan plus DIC, your buyer pool is narrower and their monthly cost is higher. Price needs to reflect that before day one, not after a failed contract 3 weeks in. If you've owned for years and you've been quietly coasting, locked in rate, same policy, never had a claim, here's why this still affects you. In February 2025, the FAIR Plan issued a $1 billion emergency assessment against the private insurers that fund it, the first such assessment in more than 30 years. Under California law, up to half of that can be passed to policyholders as a surcharge. Even homeowners with a private policy who've never had anything to do with the FAIR Plan can receive that bill. Here's the second thing to know. A Bloomberg analysis of FAIR Plan data, and I want to be precise here. This is Bloomberg's analysis cited through United Policyholders, not an official state statistic, found that 14% of current FAIR Plan policies and 28% of its total insured value now sit in largely urban, lower-risk zones. The private market pullback isn't staying in the hills anymore. It's reaching neighborhoods that nobody was associating with wildfire risk. State Farm received approval for a 17% emergency rate increase following the January 2025 fires. That's currently before an administrative law judge for final confirmation. By May 2025, the FAIR Plan had already paid out more than $2.9 billion in claims from those fires alone. So if you haven't looked at your policy recently, pull the last 3 renewal notices and look at the trend line. Then call your carrier directly and ask one question. Am I at risk of non-renewal at my next cycle? Don't wait until the letter is already in your mailbox. Per the Bloomberg analysis above, it's arriving in neighborhoods that didn't see it coming. Now let's get to the sustainable insurance strategy, because this is the main thing regulators have right now. And I want to be really precise about what it does and doesn't do. Travelers is expanding homeowners insurance availability in California as of April 24, 2026, joining Commissioner Lara's strategy and extending coverage into communities that have been underserved due to wildfire exposure. Travelers had non-renewed thousands of California policies starting in 2022, significantly reducing its footprint without fully leaving the state. That matters. But the strategy is a trade-off, not a solution. Here's how it works. Insurers can now use modern catastrophe models when setting rates, and they can factor in reinsurance costs they historically couldn't include. Both of those mean higher premiums. In exchange, they're required to write more policies for the 1.5 million plus homeowners in wildfire-distressed communities. More access at a higher price. That's the trade. There is one genuinely encouraging number. FAIR Plan enrollment growth slowed to less than 4% in Q4 2025, the first meaningful deceleration in 3 years. Regulators are pointing to the strategy as an early reason for that. Whether it holds into 2026 is still an open question. And the strategy is being pushed back on. A coalition of 40 organizations told Insurance Business Magazine in late April that insurers have dropped twice as many policies in wildfire-distressed areas since 2023 as they've committed to write under the new rules by 2028. Regulators dispute that and point to early progress. Both perspectives are out there, and the data to settle it isn't published yet. All right, let's make this practical. Whatever situation you're in, if you're buying, before you write any offer, get a real insurance quote on the actual property from an actual broker, not the lender's placeholder. Then find out whether that address can get a private policy or whether you're looking at FAIR Plan plus DIC, because those are 2 very different monthly numbers. Rerun your payment with the real quote in it. And be aware of the pending 35.8% FAIR Plan rate request and Insurify's projected 16% increase on top of that. Neither is a done deal, but they tell you which direction the market is moving. That's context worth having before you commit. If you're selling, get a broker to look at your address before it goes on the market. Know what a buyer is going to face when they try to bind coverage. If it's a FAIR Plan plus DIC situation, that affects who can buy and what they can afford to pay. Better to build that into your price on day 1 than to lose a deal 3 weeks in. If you already own, pull your last 3 renewal notices and look at the trend. Then call your carrier directly and ask one question. Am I at risk of non-renewal at my next cycle? Keep an eye out for any FAIR Plan surcharge on your next renewal. That can show up even if you've never had anything to do with the FAIR Plan itself. And if you're in one of the high exposure counties, don't wait until the letter is already in your mailbox. Have a backup coverage plan ready before you need one. Here's what I want to leave you with. The headlines say the California insurance crisis is turning a corner. A major carrier is expanding. The FAIR Plan growth rate is slowing. The sustainable insurance strategy is showing early signs of working. All of that is true. And not one piece of it means the math has gotten easier. The insurance line on your mortgage statement, the one most buyers barely glance at on the closing disclosure, is becoming one of the most important numbers in California homeownership. It is rising. By everything we've covered today, the forces pushing it higher look like they're built into the new rules, not a temporary spike. And the households absorbing those costs are the same ones already on the wrong side of an affordability gap that excludes 82% of California families from the median-priced home. Here's the difference between what the news covers and what this channel covers. The news will tell you when the policy changes. This channel will tell you what the policy change costs. And right now, honestly, it's more than it cost last year. And based on everything sitting in front of regulators right now, the trajectory points up, not down. If you're in California, drop a comment below. City or county, your annual premium, whether you're on a private policy, the FAIR Plan, or the stack. The data you share in the comments helps show what people are seeing in real time, often before official reports catch up. And it helps me build better breakdowns for you. If this helped you see the real math more clearly, hit like. Subscribe so you don't miss the next one. I'll see you there.